Hello, everyone. Welcome to the VC panel. What are VCs? What can they do for you? For me, the VCs are going to be natural wine. There's an event after this by Han Ventures with natural wine and pizza, which I've never heard of, but the VCs have now brought me natural wine. But you guys do other things too, I know. But more seriously, I've covered tech for more than 12 years in Silicon Valley, and I'm very familiar with the traditional firms and the portfolio companies and stuff like that. But crypto VC firms didn't really exist until a few years ago. First came Polychain, and then Andreessen, of course, is big, and now we have 3 more here. So I don't know, Sarah, why don't you start us off? Why don't you tell us what's different from a VC or crypto VC firm versus a traditional one, if anything?
I actually think Michael should take this one because we had a long debate about this maybe a year and a half ago. But I would say having invested at a sort of multi-sector traditional firm like Greylock, and now having recently started a new fund called Conviction, I'd say a big piece of it is crypto is sufficiently different that you do want investors to have depth in the ecosystem and to understand some of the different business models, right? And so I think that's the fundamental difference of everything is technology company building, but there's a lot to learn in the ecosystem.
Yeah, the only thing I'd add to that is you're talking about a new capital asset, also a new organizational structure, and so it requires new investment model to be able to go after that. For instance, most venture funds that you have probably heard of are not registered investment advisors. To be able to hold tokens, you need to be an RIA if you have sufficient AUM. But also, even more so, I would say, is you need to be able to add value in a way that a traditional venture investor just can't. They can't stake, they can't trade, they can't run infrastructure. At Framework, we're the largest graph node operator, we're the largest Chainlink node operator. There's a pretty good chance that if you interact with DeFi, you've interacted with us at some point, and that's just not something that any of the traditional guys can say that they can do.
I think one of the things that's different is when you do traditional VC as a generalist, you might invest across a number of different categories, companies that are in different industries, different business models. In crypto, we're building this entirely new financial system, and many of the companies are building different components that can plug into some of the other components or different products and services that some of the other portfolio companies you have can use. And so one of the things crypto VCs can do after they build up this portfolio is connect the dots within their portfolio very effectively.
So one of the boards that I sit on is a company called 0x, which is sort of core infrastructure in crypto. And I happen to sit on the board with Joey from Pantera and some guys from Jump and a bunch of other really interesting investors from what I'd consider both trading firms, crypto native investing firms, and a generalist firm. And I would say any company you are building requiring a bunch of different types of expertise, right? And so if you're building DeFi infrastructure, you probably want somebody who understands financial markets infrastructure. You probably want somebody who can bring volume to the firm. But you also probably want somebody who understands, for example, API business models and data business models and market making, right? And so I'd say I would really think about the capabilities you're looking for investors in a more specific way. And that could be volume, staking, technical capabilities, connections more broadly to other tech companies that look like an analogy to you.
Hang on one sec. I was interested in what Michael said. So if I understand right, you're not just kind of going, oh, here's my advice, kid, do this. You're actually operating nodes and getting hands-on with the infrastructure. I mean, do you guys do the same thing, or is that, do you buy this thesis that's what a VC should do?
I guess what I was trying to say is I think you will need different types of value, right? And I think what Michael's doing is super interesting, and that's going to be relevant for a bunch of companies, but it's also not for every. And so I think what are things that are fundamental to every company? You need to recruit. You need to lead the team. Guess what? Not as many people as we need to be are yet in the crypto ecosystem. So we do a lot of recruiting at 0x, at Magic Eden from other pools of engineering of people who aren't yet in crypto, and they learn Solidity, shocker, right? Or they're good at Rust and not already in crypto. So I'd say I think that some of the capabilities are sort of core and more generic, and some are specific, and you should assemble the help that's most useful to you.
Yeah, I mean, I think that being an early user of some of the products that you invest in can be very helpful for sure. We do some of that. I know Framework does a bunch of that. I also think Sarah is right that, if you're building a crypto product, you want somebody who has the expertise, because in my view, the two core things that a VC should do for its portfolio companies really well are giving fantastic advice and giving them access to a broad network of potential partners. And this is true across generalist VC and crypto. However, to do it well in crypto, you have to have the domain expertise, and you have to know, what's happened in the history of crypto and what's happening in the market right now, and have a view on where it's going. And you need to have that network within the industry. So, in many ways, my view is the best crypto VCs are just really good VCs with expertise and network within the industry.
What about motivating portfolio companies? Because when I cover traditional Silicon Valley VC, it's kind of easy to follow. There's a seed round, and you have to work like hell to get your Series A, and work like hell to get your Series B, and if you don't, you die. Like, there's just this sort of like attrition that's almost kind of healthy. But then in crypto VC, it's like, okay, 19-year-olds, here's like $50 million. Now go build this thing. And the 19-year-olds go, well, yeah, I keep meaning to do that, but I'm going to go to another crypto conference and party on this beach and stuff like that. But is there a way to kind of like, how do you kick them in the ass game to keep working when they're so rich so early?
I think
everybody feels a little less rich than they did a year ago, for what it's worth.
Precisely.
Yeah, I think it was emblematic of a moment in time. We just lived through an extraordinary bubble in tech and in crypto, and many of the companies that got funded last year and early this year are not going to survive to 2024. The fundraising market already looks completely different, and it's likely to get even worse.
I think incentives is still the best way to get people to work hard. And right now, if you have a token, maybe it's liquid, maybe it's doing well. Most likely, it's probably not doing very well right now. And so if you have an incentive model that's aligned, I think that's still the best way.
What about more seriously, what about the lockup period? I mean, are we starting to standardize on things? Because, for me, I always thought it was like a 7-year thing, you got to kind of get your exit. But, now I guess with token lockup, is there sort of like a standardized model for how to lock tokens up, when to release them and all that?
Pretty much everything has the typical 4-year vest at this point. Usually it's a 1-year cliff and then 3-year linear vesting over the remainder. We do appreciate having longer lockups because in traditional equity-based businesses, you're usually going to be there for 7, 8, 9, 10 years. That is probably more akin to how long these founders are going to have to be working at this. So we are seeing longer things, but the minimum at this point is 4.
Yeah, I would say I don't actually think liquidity is the problem or is a problem that founders and early team members have liquidity. It's more you really want vesting schedules in companies, right? Mostly because you don't want dead weight on the cap table. If you've given 30% of the company out to people who after a year are like, you know what, this is really hard. It's kind of winter, kind of sucks. Maybe I'll just go to that beach party. Somebody is left holding the bag. That could be the other founder, it could be the other early employees, it could be the investors, but we treat vesting schedules as protection for everybody who is working on the company. And so I think that in terms of a fairness mechanism is much more important than liquidity, because the reality is a non-crypto mid-stage company in a better macro environment, you also can get liquidity. People buy secondary all the time. So I actually think that piece is not very different. But I think the brief party period of vesting schedules were a year and then people could bail on projects and the community was left holding the bag, that sucked. We should not do that anymore.
Yeah, I think there's tremendous room to improve the incentive systems for crypto founders, both with longer lockups. I think the lockups have traditionally been too short. There's another issue that's a little more intractable at the moment, which is after you launch a protocol and you have a live token, there's regulatory uncertainty around how active you can be in that. So one of the things we've seen is founders of a variety of protocols have stepped away a little bit because they are trying to sort of force decentralized governance on the protocol before it's really ready, because that's a way to protect themselves from certain regulatory risks. And I'm not sure precisely what the solution is to that. Although one solution is maybe some of these protocols don't need a token until later in their lives. That's an option in some circumstances. But yeah, there's still major incentive issues to work out.
Well, sticking with governance, what about DAOs? I mean, it seems everyone wants to become a DAO. And I think probably goes to what you're saying, Travis, in terms of that's kind of like a legal dodge to, try accelerate your legal protection. But I mean, my limited dealings with DAOs is they're chaotic. I mean, do you really want to be in these Discord rooms? I don't know what you guys, I hate Discord. It's I know it's so important to the ecosystem and stuff, but it's just not a very efficient tool to use. And so this sort of the mania for DAOs, do you think that's passed, or do you think as the tools for administering them get better, they will become more useful? Or what's your current take on DAOs?
So I think that single-purpose DAOs that are seeking to solve, really short-term, one-time problems, things that kind of look like Constitution DAO, will be the things that we see succeed in the next year. And really, that's one of the broader use cases I'm excited about for DAOs, is getting a group of people to collaborate around a ideological problem in a short period of time. I think the idea that you can have decentralized governance using a token around an operating business is tenuous today, although I'd love to see more and more experimentation and progress on that front and more regulatory certainty, and to get there at some point.
So I'd say I think a lot of people in this audience, in this group, have probably thought about DAO governance, and you can have two minds about this. One is that being able to organize in a permissionless way a community on the internet is super powerful, right? We should want that. I think there are a number of core elements missing. Like, just because you can self-organize doesn't mean you don't have leadership. It doesn't mean you don't have structure. And one thing that is just like a core element that's still missing that people have talked about for a while is portable reputation, right? If I never ever manage to sign multi-sig on time, like, I'm an annoying part of your community, right? Like, you should know that about me. I don't do that, by the way, but you should know. And so I think there's core elements, there's disorganization, but it doesn't mean that organizing communities on the internet in a permissionless way is a bad idea.
Totally agree with all of that. I'd say really DAOs just represent a new governance model for decentralized protocols, and they are chaotic. They're somewhere between like a board of directors meets a cooperative, and tragedy of the commons is usually how it ends. But really, I think DAOs represent asset allocation. So what are you doing with your treasury? What are you voting on? And then, frankly, growth. And right now, there are probably about 5 DAOs that have over 100 people that are working, not just membership, but working because they're in a DAO. You can access global talent because you're working for a DAO instead of a company. And I think that we've just really kind of scratched the surface on what DAOs could be as a new form of work. But this is going to be years away.
Yeah, and to be clear, I know I was kind of hating on DAOs, but I mean, I do think the potential is huge. It just feels one of those things that's a lot further away than some of us think right now.
Just like to use an example that everybody knows, like there are lots of questions and issues around Axie and YGG, right? But like, to give credit where credit is due, they took a framework of how you could apply an economic model of people working together, and they did it globally with a quote-unquote core team of like 10 people. I think that's pretty powerful, even if you recognize all of the other issues it has as a business.
I was going to add, if anyone in the audience has questions, I think we have mic runners, so just please put your hand up, and I'll get to you. We were talking before the panel about the kind of the dust-up between Jack Dorsey and Mark Andreessen over, the whether VCs are really adding value. And there's something to the critique. It's like, with Solana, it's like, okay, the VCs get rich, and then they, dump it on Coinbase. Everyone, the insiders dump their bags, and the community and the retail is like, treated like suckers. Maybe that's their problem. But do you think Dorsey's critiques were fair?
I don't remember precisely what his critiques were, but I do think that, VCs in this industry, a lot of us, not me, but maybe them, and they're certainly A16Z, have huge platforms. A lot of people listen to them, take their cues from them, follow them. And I do think that, VCs have a responsibility not to overhype the state of things in crypto today. Because there is the potential that people who are relatively unsophisticated are going to get too excited and lose a bunch of money, right? And I think I'm incredibly bullish on where this technology can go over the longer term. One of the things I think we saw last year is a lot of people basically saying it has arrived, right? Like the new financial system is here, the metaverse is here, you know, corporations are you know, history. When in actuality, what I think we saw was really like proof of concepts, not the end state. So, you know, I do think that in that sense, yes, perhaps some of his critiques were fair.
His critiques were absolutely correct. You know, and not to say that they're going to continue to be correct, but a lot of the battle was whether or not Web3 has proven anything out. And to your point, Travis, it's all been proof of concept so far. Nothing has really hit consumer adoption, consumer scale yet. But historically, and I think what Mark Andreessen was talking about, is when you see the development of a platform as wide as the internet or as wide as maybe, you know, blockchains or Ethereum in particular, you know that something will happen because of that. And that's the point that we're at right now, is something will happen. And we all have our own theses as to what's going to be that thing. But generally, I would say, you know, the platform leads the application, and we're in that transition moment right now.
So this is not my like Twitter fight to fight, but to you know, touch on something that Travis mentioned. Like I wouldn't do the job of like early stage venture investing if I didn't think that we're something fundamentally valuable to the ecosystem or to entrepreneurs. And my framing of that is the first is like, yes, you're taking risk with your capital and other people's capital, but as you know, the largest LP in my own fund, like it is my capital, right? Another piece is really like being an entrepreneur. And my parents were both entrepreneurs, and it's like we bootstrapped the business until it was 30 million in run rate, doubling year on year profitable, right? That was very hard, and part of it was not having advice and sponsorship of anybody who had connectivity in the industry. Or like any sort of tribal knowledge of what had come before, right? It's just a bunch of engineers like fumbling around in the dark, ungenerously. But I, from that lived experience, I'm like, okay, you know, somebody is going to do the work, but maybe we can give them a bunch of advantages in terms of a platform, connectivity to people who have some tribal knowledge for them, resources, ways to give them distribution, because nobody cares about your startup, right? And I think that's like very worthwhile doing. That doesn't absolve venture capitalists of the responsibility of like responsible communication to financial consumers, but you know, I think we're kind of mixing a bunch of issues here.
I got a different sort of question. In terms of people approaching you, you know, I've got a startup, you know, you care about my startup, you know, I don't, but I'm saying if I wanted to get it in front of you, is anything different in the kind of like through the crypto paradigm than, you know, in the, you know, more conventional Silicon Valley thing, the way projects come into you, the way you take meetings and so on?
Maybe I'll comment on this because I might have looked at more normal non-crypto software companies than both these guys. I think the fundamental thing is like every VC is different. They're all idiosyncratic animals, but most of them will tell you something along the lines, especially as early stage investors, that you know, they're investing in people, they're investing in markets, and they're investing in some sort of product thesis, right? People, everybody's going to make their own judgment of what core entrepreneurial traits are, and then like what you've actually achieved at whatever point, you know, you interact. But it's also like, who are the networks, right? The networks in you know, building a SaaS company are quite different from the networks in building a crypto company. If somebody's like, okay, well, you know, I'm a core contributor to this very important project, I am paying more attention in crypto, right? If somebody's like, I built the ranking algorithm at Facebook, I'm paying more attention in software, right? And so I'd say like one fundamental difference is people on markets and products, to some of the discussion we were having earlier, like you just need a different set of context, but I think you're fundamentally looking at many of the same things, right? Like, is there technology differentiation? Do I believe in the secular direction of the company? And like, is there user value somehow?
This may be a bit tangential, but one thing that we don't see a lot of that I really like to see, particularly in moments like this, is founders who have a unique view on where this market is going. I think that for the past couple years, everybody's like, the market's going up, crypto is going to take over the world. Everybody's going to, own all these NFTs, and not a lot of people had a unique perspective. So I really love to see when people have thought, from first principles as to like where the world is going and why they are building what they're doing. And that's where I think the ideas start to look a little bit more interesting.
We only have 3 minutes left, and I want to end on an up note. It's winter and so on, but it won't be winter forever. So can all of you just take 1 minute and tell the room which area you're most optimistic about? When winter ends, what's going to be the next big thing that we're excited about? You want to kick us off, Michael?
Sure, yeah. I'd say the thing that we're most excited about, probably what we see 60 to 70% of the time, is a new gaming-related pitch. Game, publisher, studio, infrastructure provider, all related to gaming. And if we think about gaming, gaming has 3 billion monthly active users, 200 million in annual revenue, 200 billion in annual revenue, and there's about 60,000 addresses on Ethereum right now that have an NFT and transact daily. So the market that we have right now is infinitesimally small. The utility of NFTs, I think, ultimately aggregates towards gaming. And we've just started to see what has happened with the IDFA and basically Apple, Google preventing free-to-play, which is the dominant driver of that 200 billion, being able to eviscerate their business model with basically one update. So we're seeing a ton of new entrepreneurs. Most of these games are going to be fun to play as opposed to what we've seen so far. And most of them are launching in the next couple of months.
I'm going to be cheap and give an answer and a half because I'd say that's absolutely super interesting. And if you think about the state of play in crypto gaming today, it's not very good, right? Like you have a couple standout interesting concepts and you're like, hey, Dark Forest, that's actually like kind of innovative. And then like a lot of stuff where you're like, would people play without an economic incentive up front? No, right? So we have not cleared the bar yet. But I think that is going to change, and I think like if you can easily, all of us can easily imagine gaming concepts that have economics and portability baked in that could be amazing that just actually haven't been implemented yet. So I think that's like a really big opportunity. To build on that a little bit, I think there's a way to look at NFTs that is like incredibly dismissive, which is like, how much is the like global market cap of JPEGs gonna be really, guys? And like you could perhaps accurate be like, I don't know, not that big. But if you ask, does anybody know the average amount of time an American adult spends on a screen a day?
25 hours.
Okay, so he's correct about me, but the answer is 8 hours and 41 minutes last year. That's a lot of time, right? And so if you ask a teenager, like why'd you buy a luxury item? The answer is so I can put it on TikTok, right? It is not so I can, our social interaction has just dramatically changed from, I'm gonna go out with my 3 friends to like, I'm gonna broadcast like what I'm doing, and it doesn't count unless 100,000 people saw it on TikTok. We can argue about whether that's good or bad, right? Really not the thing I'm discussing right now, but I just say like, if we live our lives increasingly online, do you think online identity and assets will be valuable? Because like, I feel like that's an easy yes.
For sure. I got to cut you off, sir. We're about out of time. I do want to get Travis in. What are you excited about for the next crypto spring?
Interoperability and app chains.
A little more than that?
I thought we were out of time.
We are, but I didn't understand what you said.
Interoperability and app chains. So I think that in its end state, crypto is an interoperable network of networks, that there will be generalized chains that have a bunch of apps built on top. But I think some of the most interesting development that we're going to see over the next year or two is in perhaps the Cosmos ecosystem with new networks like Axelar and others. So from an infrastructure perspective, that's what we're excited about.
Neat. Okay, well, that was fun. Please give it up for our VC panel. Thanks very much, everyone.
Thank you.